what's currency theory? Let's just get right to it. But first, I have to say, nothing in this video or on this channel is financial advice, and I'm not a financial advisor. Now, I wanted to make this part 2 to my Everything Bubble Pop video because I missed something key in part 1, the yield curve inversion. For those who don't know, the yield curve is a graph of current interest rates on bonds from the same institution, usually the U.S. Treasury, but with different maturity dates, such as the 3-month U.S. Treasury versus the 30-year U.S. Treasury, or the most frequently referenced 2-year to 10-year U.S. Treasuries. Usually, the long-term bonds pay higher yields than shorter-term bonds, but occasionally, the yield curve inverts and short-term bonds start paying higher interest rates than long-term bonds. Inversions of the yield curve have historically been an extremely strong predictor of economic recessions in the past, and for good reason. Looking at supply and demand dynamics, it makes sense from the investor perspective, the borrower perspective, and the central bank perspective, which we'll explain here shortly. From 1969 to 2020, there's been exactly 8 incidents of yield curve inversions and exactly 8 recessions. All 8 recessions coincided a yield curve inversion or a tightly timed cluster of yield curve inversions. These 8 recessions have started after the yield curve inverted, either while it was inverted or within 24 months after the inversion reverted back to normal. What's more is that the duration and depth of the yield curve inversions are correlated with the depth and duration of their corresponding economic recession. And while it just so happens that it's arguably the most severe yield curve inversion ever recorded in U.S. history, at least according to some metrics, just occurred from June 2022 to September 2024. We're now 17 months past the reversion. This was the steepest and longest lasting yield curve inversion in U.S. history. Now, if we're going by historical precedent, the economic issues stemming from the Russia-Ukraine conflict, whether you want to call it a recession or not, would not be this particular yield curve inversion's corresponding recession, because historically speaking, the aforementioned 8 yield curve inversion incidents have only preceded economic downturns, and this yield curve inversion would have succeeded it. Moreover, yield curve inversions historically have not persisted through the economic recovery, and this particular inversion did persist through the 2022 economic recovery. So this record-breaking yield curve inversion is yet to have a corresponding economic contraction that would fit the historical precedent. So, to add to my list of reasons from the part 1 video of this part 2 video, I should probably go ahead and discuss the yield curve inversion, especially because there's a perspective on this yield curve inversion recession relationship that almost nobody knows about, and I'd like to shed some light on it. But before I go on, I highly recommend, if you haven't watched the part 1 to this video, doing so, as it is the bulk of my reasoning and will make this part 2 make a lot more sense. Now, everybody who's been taught about why the yield curve inverts has been taught to see it from the investor's perspective. So to be sure, I'll give a brief explanation of the investor's perspective before explaining the borrower's perspective and then the central bank's perspective. From the investor's perspective, the yield curve inverts because investors think that the probability of low or negative economic growth in the near future is high, which will cause the Fed to go into quantitative easing, which will in turn cause long-term yields to come down in the near future. So investors flock to long-term treasuries on the expectation that yields will come down in the near future. Note that long-term bond prices are affected more by interest rate changes than short-term bond prices, given the same change in interest rates. So a decrease in long-term interest rates can be quite lucrative in terms of bond prices. And note that bonds can be sold for capital gains on the open market before they mature. So the prospective returns of long-term bonds cause investors to decide something like, instead of getting 5% yield return for a month or a year or whatever short-term bond you want to look at, they prefer to get 4% for 10 years or 30 years or whatever long-term bond you want to look at. Obviously, this is inverted because the more volatile and therefore risky an asset is, the higher the return an investor should expect on it. And as just mentioned, longer-term bond prices are more volatile in response to interest rate changes than shorter-term bonds. And if the investor plans to hold the bond until it matures, then the investor should require greater returns for the longer period of time that they have to go without their initial investment, especially since longer term bonds risk more time for market conditions to change and offer better yield, and more time for their borrower to go belly up and default on the bond payments. But in some rare instances, the market calculates that the best move is to lock in lower rates on longer term bonds on the expectation that interest rates will come down and long term bond prices will offer substantial returns, especially compared to other investment assets which are likely to suffer in the expected economic downturn. Moreover, if investors suspect rates are going to come down across the board, they won't want to roll their principal over into the new bond rates that have since decreased. Some investors are thinking, okay, the yield on the 1 year is currently 5%, and the yield on the 10 year is 4%. But next year, when I would get my principal back on the 1 year and try to reinvest it, the 1 year will probably only be paying 1%, and the 10 year will probably only be paying 2%. So I guess the best move is to lock in 4% rates for 10 years. This is when the yield curve inverts. So, from the investor perspective, the yield curve inverts because investors are betting on poor economic growth and subsequent quantitative easing in the near future. But this perspective is only part of the picture. Remember, all of this money starts from the Fed, and the Fed only lends the money with interest. So the Fed does not supply enough money to pay back the debt that is owed to it. Moreover, there is not enough money in the economy at large to pay off all the debt in the economy at large, because the rest of the money is created by the money multiplier, which is created by banks lending money, which increases the debt by the money multiplier, plus the interest that's added on to the money multiplier. So now, this adds to the picture of why the yield curve inverts before recessions. When a large percent of the money supply is coming due to pay off debt, the debt can overwhelm the money supply, making it harder for entities, large and small alike, to come up with the funds to pay off their debt. This sizable debt collection, which removes just as much money from the economy as debt, can create a significant spike in the debt to money ratio, as discussed in my previous videos. This causes a scarcity of money, generally speaking, relative to the debt. But that should cause interest rates to go up, generally speaking, not specifically short term, right? But this inversion occurs when the issue goes beyond expensive money and capital and turns into a liquidity problem. When the situation gets really bad, large, deeply interconnected financial institutions might be the ones upside down looking for credit money to pay off their debt coming due. And other large, deeply interconnected financial institutions might be financially dependent on the first institution struggling to come up with needed funds. Now, these financial institutions are used to being able to recycle their debt. So, as is typical practice, when they find themselves short on funds that they need to satisfy debt payments and reserve requirements, they look to the short term lending market to satisfy their credit and liquidity needs. But this time, with the massive debt collection looming, they aren't one of just a few important financial institutions who are looking to borrow funds to help pay off an overwhelming amount of debt coming due. They are one of many. And the stronger institutions that these weaker institutions are used to borrowing from are either getting more calls for credit and seeing their reserves drain below the norm, or are even looking to borrow themselves now. So, in order to acquire the funding that they need from this limited pool of liquid money and credit, they have to offer to pay more interest. They have to incentivize other institutions to lend their now scarce reserves, and they have to reduce the risk to the lender by promising to return the principal sooner rather than later. These struggling institutions can't go demanding long term capital when the market can't even provide short term liquidity, and the lenders are getting more nervous about running out of reserves as well. The weak institutions, in a desperate bid for short term credit that is low in supply, offer to pay higher interest rates on shorter term bonds. If they don't get these funds, their organization defaults and fails to survive. So these borrowing financial institutions become beggars who can't be choosers. Even if there are still a few strong financial institutions out there who have the reserves to meet the market needs, By the time the dire dynamic of the rest of the market has revealed itself, the few strong institutions remaining can monopolize liquidity and reserves and demand higher rates on short term credit. So, from the borrower's perspective, the yield curve inverts because struggling institutions make desperate bids for short term credit. An extreme example of the market being flooded with short term debt by desperate institutions was in the September 2019 Fed funds rate spike, where desperate institutions who needed money to pay off their debt coming due the next morning flooded the market with short term bonds, and the Fed funds rate, often called the overnight rate, spiked from 2% to 10% in just a few hours. This rate is supposed to be tightly controlled within a quarter of a percent, and at the time was supposed to be between 2% and 2.25%. And yes, the yield curve did invert a few months before the 2019 credit event, and reverted a few months before the start of the 2020 economic contraction. I think the followers of this channel know that's not coincidence. Now, the Fed wound up increasing the short term money supply drastically in order to get the overnight rate back under control. And if you don't know why I say short term money, you will by the end of the video. Some might call it credit or liquidity, but I prefer short term money here. Now, there's risk for the Fed to sizable increases in the money supply, especially the long term money supply. And we'll discuss these risks here as we explain why often the yield curve reverts back to normal before the corresponding recession starts. This is where we get an interesting look at the yield curve inversion from the supply of money and Federal Reserve perspective. So the yield curve inverts because desperate borrowers need to borrow money to stay afloat, causing a large bid to occur for short term credit and liquidity instead of long term capital and leverage. So why does it revert sometimes before the recession hits then? Well, the Fed can always print more money to bid down rates, but the Fed has to consider inflation, and to do so, they have to consider the velocity of money. Remember from the part 1 video that MV equals PW. That is, money supply times velocity of money equals price times wealth. The worst move the Fed can make is to hyperinflate their product, the dollar, aggressively enough to strongly incentivize the market to revolt against it. Now, the traditional view as to why long-term bond purchases by the Fed drive up velocity more than short-term bond prices is that when the Fed buys long-term bonds, it drives up asset prices, like long-term bonds, of course, but also housing, and then as a byproduct, stocks, and all of that encourages borrowing and consumption. Now, this is a valid view given the monopolistic debt-based monetary market structure, but it's not the only valid perspective, and it's quite a convenient perspective for a monetary monopoly. If all of the money is due back to its lender, what money is going to be spent more frequently and change hands faster, thereby causing more inflation? Money due back next year or money due back 30 years from now? Which would you feel more comfortable spending, and which would you decide you need to hoard? Moreover, the biggest players of this game know that when it begins, there can never be enough money for everybody to pay off their debt, and the situation can only get worse over time. The first layer of borrowers know that if they want to be one of the winning, solvent institutions that doesn't lose everything in a default, they have to earn yield. They have to out-earn their interest, and they have to out-earn enough of their borrower competitors to pay off their debt. So not only is longer-term debt incentivized to chase yield, and therefore change hands faster, going further, and bid prices up more, it's basically forced to chase yield and change hands faster and bid prices up more. Because that's when there's still enough time for the market participants to earn enough yield to pay off their interest. And it's also at the point in time when market participants should be finding quantitative tightening to be more likely than quantitative easing to come and bail them out of any financial distress. Generally speaking, the big players in this economy have to earn enough yield on the money they borrowed to pay off their interest in an environment where there's not enough money for everybody to do so. So if you can imagine the start of this financial system, you can see what I'm saying. Let's do a quick hypothetical example to fully grasp the concept. Let's say the economy starts with zero money, then the central bank starts it off by lending, say, $100 billion to 100 different institutions. It's a 10% interest. so that there's $100 billion, but $110 billion worth of debt that the economy has to pay off. And each of the 100 institutions has $1 billion and $1.1 billion worth of debt to pay off. How do these institutions behave when a lot of the debt isn't due for 30 years? Especially when there's a money multiplier effect. They try to earn yield so they can pay off their debt. How do they behave when $90 billion have been collected by the central bank in debt payments and it's down to $10 billion in total and $20 billion of debt, all due back in 3 years? Well, the institutions have either already earned the yield needed and are not going to risk losing yield and defaulting at this point, or they haven't earned the yield and they go begging and hoping for credit from institutions with plenty of reserves and liquidity, maybe even the central bank. Chasing yield when there's $10 billion in liquidity and $20 billion in debt that's all due back in 3 years is like being lost at sea and dehydrated. Even if it seems like you're surrounded by what you need, your best bet is to hope for rescue before it's too late. And even if the market were back to the original supply of money, $100 billion, and the original amount of debt, $110 billion, but it was still all due back within 3 years instead of 30 years and spread evenly across those 3 years. If you were an average example of the 100 institutions, then 1/3 of your money plus interest would be due back next year. So even if somehow the Fed did lend $90 billion at 0% interest, the fact that it's all due back within 3 years would incentivize you to sit on a lot of it relative to if your debt obligations were spread across 30 years. And you'd probably hope for more QE instead of risking losing too much of your money by chasing yield with too much of your money before a big debt obligation comes due, especially because this is the point in time when QE is most likely. And so these institutions who know not to drink the seawater hold on to their remaining reserves the best that they can in hopes that the Federal Reserve will rescue the market with quantitative easing before they dry up and default. So we can see from this extreme hypothetical why short-term money from short-term lending from the Fed has lower velocity than long-term money from long-term lending from the Fed. So the Fed has two options when the yield curve inverts and the big borrowers get desperate. They can either let the financial system collapse and collect the collateral, or they can inflate the bubble and set themselves up for bigger and better collateral collection next time. But the Fed has to be careful not to hyperinflate too much. So they increase the money supply, but target to shorter term rates in order to keep the velocity of money under control so as to not hyperinflate their currency to zero. Now, this means that a greater percent of the money supply is getting collected each collection that comes due, at least on average per collection, compared to if the debt owed back to the Fed was more equally distributed across all bond length maturities instead of being skewed towards the short term. And these larger debt collections means that the debt to money ratio spikes that collections cause will also increase, causing greater increases in interest rates, causing interest to compound at a greater rate, which feeds back into increasing the debt to money ratio, which, to reveal the full spiral, increases the average percent of the money supply being collected per debt payment. So when we see yield curves invert, we have a good reason to believe somebody big is in financial trouble. And when we see them revert without a recession, we have a good reason to believe the Fed has applied a monetary band-aid. However, the recession still comes because a large sum of debt relative to the money supply is still coming due that creates a scarcity of money, making money tight. And even given the recession, this monetary band-aid is only a temporary fix that makes the problem worse the next time. As interest compounds over the money supply, it takes greater percentage increases in the money supply to decrease interest rates, and greater percentage increases in the velocity of money to stimulate growth, risking hyperinflation. And yet still, greater and greater percentages of the money supply are coming due on a regular basis, making money increasingly more expensive and scarce. Hydrating the economy becomes impossible. Eventually, the only way to alleviate the debt burden is through defaults on a grand scale that cause economic calamity for basically everybody but the banksters and a very few well positioned individuals, just like the Great Depression. So, on top of all the reasoning we had in the Part 1 video that the everything bubble will pop on Trump, we can also see that the yield curve has inverted, which for good reason has been a very strong indicator of a coming recession. Considering everything in Part 1, from the crazy interest rate shock in 2019 to the giant globally coordinated scam perpetrated shortly after that, which created a diversionary justification to bid down rates with hyperinflation, I think the magnitude of this recession will reach the scale of a depression. It's way overdue. And when I say diversionary, I mean it diverted attention from the tax demand driven monetary monopoly embodied by the central banking empire that's headed by the Federal Reserve as the primary cause underlying systemic financial distress and, quite frankly, the global tiptoeing totalitarianism. To bid down rates with more money this time will more likely than not be even more inflationary than the last time they did it in 2020. And what a bold card they played in 2020 in the face of the entire population. I don't think the people will have anything like that again. Both bidding down the debt to money ratio again, with even more hyperinflation this time, and a black swan event similar to what we had in 2020 would be too risky for the monetary empire. We have good reason to believe the severity of this recession will have a causal relationship with the debt to money ratio, which is reflected in recent interest rate volatility, such as 2019, and other interest related anomalies, such as the yield curve inversion, and price volatility, such as what we saw in 2020, should also be seen as quite indicative of the condition of the monetary system and therefore the economic system. The monetary system is the biggest variable in regards to the economic system. The monetary market is the biggest market. It's good in exchange for all the other markets combined. Also, the stock market is shot way up, way beyond the elbow, and it's clearly forming a bubble structure. It's not looking overdue for a typical correction. It's looking overdue for a pop, which aligns with the prediction of a depression, not just a recession. Furthermore, the monetary empire has just the right kind of administration in office to be the scapegoat for the bubble popping. They can blame the Trump administration, and they can blame deregulation and or tax cuts. A powerful excuse to increase the central banking empire's control of the global population by proxy of its biggest debtor, the government, who alongside the media, whom the monetary empire also controls, will try to convince the people that more government control through more government spending, regulation, and taxation is necessary to prevent things like this from happening in the future. If you want to know more about how the central banking empire ultimately controls the media, you should probably watch my video, Chronicles of Today's Monetary Empire, a reinterpretation of money, history, and economics, specifically from the beginning of the corporate control section to the final corporate control section. Now, those who understand the economics of politics and governments, or problem reaction solution, know that this increase in government control is intended to cascade, as the government solution to the problem creates more problems for the government to solve, creating a problem reaction solution, problem again chain. So it's all lining up for the monetary empire to collect on all the collateral it's been building up via compounding interest. I know I was wrong about 2025. I put a little too much weight on Jim Cramer's precise inaccuracy, but I think you got the idea. Now, since I mentioned tax cuts, but failed to mention their relationship with the bubble in the Part 1 video, I figure we should cover them here. Tax cuts have a similar effect as deregulation in increasing the velocity of money, creating the inflation that enables the Fed to create a shortage of money relative to the debt. Tax cuts increase the velocity of money because a greater percent of the money winds up in the hands of the private sector, who is less indebted than the public sector. And because the private sector has less debt relative to the money they have to pay off their debt than the public sector, the money can be spent more freely, going further, bidding up prices more. Now, I know what you may be thinking. Since when has debt slowed down government spending? You may even argue the Laffer Curve if you're aware of it. And while these are valid points, tax cuts are still the government foregoing money it doesn't have, at least up front, but will spend anyway, and giving the people a kind of discretionary surplus to play with. And when I say up front, what I mean is the government is foregoing a percent of taxable income, but may actually collect more in taxes as per the Laffer Curve principle, whereby tax cuts stimulate the economy enough to where the increase in the economy's taxable income is a large enough percentage to more than override the decrease in tax rates, causing a net increase in the government's tax revenue as a result of the tax cuts. That increase in income is reflected in MV equals PW as an increase in V in some combination of W and P. So it wouldn't be an increasing money base the government is collecting taxes from, but really what's basically an increasing money multiplier resulting from an increasing velocity of money. And yes, that does mean that I'm viewing M1 and M2 as metrics of velocity, not the money supply, and I'm viewing the Fed's balance sheet as the money supply, at least in this context. I'm not saying it's always appropriate to view M1 and M2 as velocity of the Fed's balance sheet, but M1 and M2 are created by money that changes hands after the Fed prints it. So the effect of tax cuts on monetary policy is just like deregulation. They cause money to chase new opportunities, increasing the velocity of money, and therefore inflation. This enables the Fed to reduce the money supply, which causes the debt to overwhelm the money supply, which then causes economic calamity that the empire can then blame on the tax cuts, diverting our attention away from the underlying cause, which is the monetary monopoly, and providing them an excuse to take more control and more of our freedom with even more oppressive taxation. So obviously I'm not against tax cuts. I'm just explaining how they fit into the MV equals PW and the compounding interest debt bubble frameworks, which we've combined here and which we explained in great detail in the part 1 to this video. If you want the tax code right, you have to remove taxes on bartering and private currencies and assets acquired via such first. This might sound silly or insignificant at first, but it's not. I'll explain. Removing taxes on bartering and private currencies and assets acquired via such would enable us to use private currencies instead of the national currency to avoid taxes we find egregious. This would cause the national currency to lose demand and purchasing power compared to alternative private currencies, such as business vouchers, precious metals, cryptocurrencies, and the like, as a result of egregious taxes being implemented, which would make egregious taxes unaffordable and unsustainable for the government. For example, if you buy property with $1, you pay property taxes if that's the rule for using the dollar. But if you buy property with silver, or vouchers, or through bartering, or with crypto, or whatever the two consenting parties in the transaction find acceptable, no taxes should be applicable. Sales and income earned in your private voucher currency shouldn't be taxable. Taxing the private voucher sales and income in dollars causes a short squeeze out of the private voucher and into the dollar, or whatever tax demand currency your country uses. This renders private currencies inviable. And taxing the private vouchers in private vouchers still gives some entity an undue monetary surplus, which would still lead to the establishment of a monetary monopoly, just like our central banks. So taxes on bartering and private currencies, the latter of which the government presumes to be bartering because they presume money to be a state monopoly, forces you to use the dollar, creating enough of a demand surplus for the dollar to establish a monetary monopoly. But you see how removing taxes on bartering and private currencies would then bring other egregious taxes, and really any other government overreach, back under control through the forces of supply and demand. This free market monetary thesis is explained in great detail and proven beyond reasonable doubt in Chronicles of Today's Monetary Empire a reinterpretation of money, history, and economics. But anyway, let's get back to the bubble pop. On top of everything I'm seeing, the best technical analyst I know, blockchain backer, or BCB for short, thinks that the top of the United States equity bubble is probably coming this year. Now, some of you may think chart analysis is like astrology. As somebody with a finance degree who was never taught chart analysis in school, I can tell you it's not. First of all, blockchain backer's extremely accurate and even precise track record of not only predicting price tops and bottoms for various assets, but even predicting days of significant news events is no coincidence. So here are two of the reasons why I think chart analysis works when you're really good at it. One, in an economy and in markets where supply and demand are as managed as ours is, the price of assets aren't going to oscillate around their supply and demand equilibrium. And in these unfree, controlled markets, participants are incentivized to speculate instead of actually adding value or trading value. In an ultimate form of speculation, if not the ultimate form of speculation, is trading volatility. It's more natural for market participants to trade volatility than it is for them to trade for value in these markets. Just think about how little information most of us have compared to the insiders. So naturally, volatility will oscillate around equilibrium, which can be seen in the volatility index, known as the VIX, and prices will not oscillate around their equilibrium, given this current artificial market structure. And this regression toward the mean in volatility equilibrium, but not price equilibrium, should show up on asset price charts as indirect movements toward price discovery in somewhat wonky and often cyclical patterns. Number two, with speculation and volatility trading being more natural than value trading based on fundamentals, we should also not be surprised to see self-fulfilling prophecies show up on charts as well. If enough traders believe it to be true, then they will trade the prophecy into existence. Now, eventually, as more traders anticipate the move, the edge erodes, and the pattern changes, effectively causing it to be traded out or outdated or maybe even out of style, in a sense that it could come back into style. Now, I have more reasoning as to why charts matter, but that's a topic for another video. But you see why I never sneeze at chart analysis that makes sense and has a proven track record. I've seen it proven to be highly effective beyond reasonable doubt. BCB hasn't just been consistently accurate for a long period of time, but his analysis clearly makes sense before his accuracy is confirmed by the market. And blockchain backer's most recent analysis of the stock market, where he predicts the US stock market bubble will pop, makes a lot of sense. So I'm going to do my best to explain the bubble pattern he's seeing forming in the stock market with some examples of it. So what it looks like is back-to-back waves of similar size, although those aren't always necessary, I don't think, but they do add to the confluence when they're there. These, if they're there, are then followed by a double tap bull flag, followed by a breakout, followed by a violent back test, which leads to a V bottom recovery, followed by 5 waves up, then the bubble pop. Now I'll show you a few more examples before I show you on the S&P 500 stock market index. Now, I already showed you Bitcoin from 2018. Here we have Apple from the dot-com bubble. Here we have Ethereum from 2018. And here we have Citigroup. Now this one looks a little bit different. It doesn't have the 2 waves coming in, and then it goes into a retrace that short squeezes barely into a new all-time high before the bubble pops. And this one's not quite as distinct and clear as the others, but you can kind of see it. Now I'm not saying all bubbles look like this, with a double tap bull flag, breakout, violent back test, V bottom, 5 waves up, but they all have that super exponential growth curve, which we can see here on the S&P 500 stock market index. But we can see here that the S&P 500 does have the 2 humps, followed by the double tap bull flag, followed by the breakout, followed by the back test, violent V bottom recovery, 5 waves up. And I also want to show you the Dow Jones Industrial Average, because it's been around for much longer than the S&P 500, so we can zoom out on it and see the stock market's super exponential growth curve a little bit better. Oh, and note, silver and gold have both broken out way into new all-time highs. an ultimate hedge play against systemic financial trouble. So I know a lot of this points to an epic bubble pop and a Great Depression, but this isn't all necessarily economic gloom and doom for everybody. Plenty of millionaires were made in the Great Depression, and I think the coming crash offers quite an opportunity, which I've been putting my chips on. Now, those who have really followed this channel know it isn't really about my specific investment strategies or plays, so I'm not going to share my play here. It's risky, and you have to know what you're doing. But if you're curious to know about it, then please leave a comment below, and I'll consider explaining what I'm doing and how it works. And I'm not saying this market couldn't continue going higher, but I personally don't think we've got much room or time left to run with the bulls. I personally still have some macro long positions to hedge against my short position, which I'll roll into my short position if given the opportunity. Again, none of this is financial advice. Please don't forget to like, subscribe, and share. I'll see you in the next one.